Some people grind for years to build wealth, only to stall out just when they are closer to success than ever before. It is not because they stop earning or because the market turns against them. It is because they hit a psychological shift they never saw coming. A shift that changes how they think, how they spend, and how they invest, without them even noticing. That shift happens at $250,000. This is a milestone that feels like massive progress, but it acts like a trap for anyone who does not understand what really happens next. In this year of 2026, with markets moving faster than ever, understanding this rule is the difference between true freedom and staying stuck in financial mediocrity. Today, we are diving into what is known as the $250,000 rule. I guarantee that what you are about to hear will completely change how you think about building wealth. If you find this analysis helpful for your financial journey, please take a second to hit the like button and subscribe to the channel. Sharing your thoughts in the comments section below also helps us reach more people who are trying to navigate these complex financial waters. You save $10,000 and you are $10,000 richer. You save $50,000 and you are $50,000 richer. It seems like simple math, but here is what nobody tells you. There are specific dollar amounts where everything changes. These are points where the psychology of money shifts so dramatically that your entire relationship with wealth gets turned upside down. $250,000 is one of those amounts, and in today's economy, it might be the most dangerous one. According to recent data from early 2026, the average worker will earn millions during their lifetime. Yet, most people still approach retirement with very little in actual liquid savings. Where does all that money go? It is not just about bad spending habits. It is about psychological traps that kick in at specific wealth levels. The biggest trap of all happens right around $250,000. Reaching $250,000 in investments is the moment wealth stops feeling theoretical and starts feeling real. This is the point where your money begins moving faster than you do. One good day in the market can earn you more than your entire weekly paycheck. One exceptional month can generate more passive income than some people make working full-time. But this is also where it gets dangerous. It is the point where one wrong decision can erase years of careful progress. Think about it this way. When you have $5,000 invested, a 10% loss means you lose $500. That is painful, but it is not life-changing. When you have $250,000 invested, that same 10% loss costs you $25,000. That is more than the total annual savings of a typical household. Suddenly, the stakes are in a completely different universe. The real danger of hitting this mark is not just the potential for loss. It is something far more subtle and destructive happening inside your head. There is a fascinating psychological phenomenon that kicks in around this level. It is called the illusion of arrival. You start seeing your portfolio jump $5,000 in a single day. Suddenly, your brain starts playing tricks on you. You begin thinking you have made it. You start feeling wealthy. And that feeling is exactly where most wealth-building journeys come to a screeching halt. Imagine checking your investment account on a Tuesday morning and seeing you are up $8,000 from the day before. Your brain immediately starts calculating that this is more than you used to make in a month at your first job. You feel like you deserve to celebrate. Maybe it is time for that luxury vacation or that car upgrade you have been putting off. After all, you are practically rich now, right? That is dead wrong. And this is where the $250,000 rule becomes absolutely ruthless. At this level, you are not rich. You are not even close to rich. What you are is dangerous to yourself. You have just enough money to make really expensive mistakes, but not enough money to recover from them quickly. That gain you saw on your screen is unrealized. It exists only on paper, in the digital realm of your brokerage account. It can disappear tomorrow, just as quickly as it appeared. But that $10,000 luxury purchase is very real and very permanent. It is capable of setting your journey back by months or even years. This illusion of wealth before you are actually wealthy destroys more financial futures than market crashes ever will. But it gets even deeper. There is another monster lurking at this mark called the overconfidence monster. You have managed to accumulate $250,000 through discipline and perhaps a bit of market luck. Your portfolio has grown steadily for several years, and you have weathered a few downturns. You start believing you are an investing genius. This is when people go completely off the rails. This is when conservative investors suddenly think they can pick individual stocks or chase the latest digital asset trend. This is when the phrase, "I can afford to lose this," becomes the most expensive sentence in the English language. The cruel irony is that you finally have enough money to make the kind of mistakes that set you back for a decade. You can afford to gamble $20,000 on a speculative trade. The problem is that being able to afford a loss and being able to recover from that loss are two different things. One bad decision at this level can delete 5 years of compounding growth. Think about that. 5 years of disciplined saving and delayed gratification, all wiped out because you thought you were smarter than the market. The bigger your account gets, the more confident you become, and the bigger the mistakes you are willing to make. It is like psychological quicksand. There is also the comparison trap. You reach $250,000, and for a brief moment, you feel successful. Then you meet someone with $500,000, or read about someone your age who has $2 million. Suddenly, your progress feels small. They increase their risk tolerance beyond rational limits. They start making desperate moves to close the gap between where they are and where they think they should be. The comparison trap is vicious because it never ends. There will always be someone with more money than you. The moment you start measuring your success against someone else is the moment you stop appreciating your own journey. At $50,000, comparing yourself to a millionaire does not change your strategy much. But at $250,000, you have enough money to make stupid decisions in the name of catching up. This is when people start taking out loans to invest or leveraging their portfolios. They convince themselves that taking on debt to invest is just being strategic. They think if the market returns 10% and they borrow at 6%, it is free money. In this current year of 2026, that kind of thinking is how people turn a temporary setback into a permanent catastrophe. I have seen solid portfolios destroyed because someone decided they needed to allocate $50,000 to a high-risk asset just because they saw someone else getting rich quickly. The brutal truth is that you are at the most dangerous point in your entire journey. You have enough money to hurt yourself, but not enough to protect yourself from your own bad decisions. So, what is the secret? What do financial advisors rarely mention because it does not sell products? The real secret about hitting this milestone is not about what you should start doing differently. It is about what you should absolutely not do. You do not need to get fancy. You do not need to start picking individual stocks or diversifying into complex real estate trusts. You do not need to hire a manager who will charge you a percentage to tell you what you already know. What you need is something that sounds boring. You need to keep doing exactly what got you to this point in the first place. Continuing to do the same boring thing when your balance is jumping by thousands every day is incredibly hard. It feels like you are not maximizing your potential. Your brain shows you all the opportunities you are supposedly missing. You see stocks that went up 300%, or digital assets that made people millionaires overnight. Surely with your foundation, you could afford to take some of those risks. This is the exact moment where discipline becomes more valuable than intelligence. Boring is beautiful, because when you stay boring at $250,000, something magical happens. First, your money starts working harder than you do. If you have this amount invested, earning an average of 8%, that is $20,000 in growth per year. That is more than many people save in their entire lifetime. And your money generates that every single year without you lifting a finger. Because of compound interest, that $20,000 in growth starts earning its own returns. The growth starts snowballing in ways that will genuinely shock you. From $250,000 to $500,000 takes about half the time it took you to get from zero to the first $250,000. The second $250,000 comes twice as fast as the first, and the next one comes even faster. This is why this milestone is the point of no return. If you can resist the psychological traps at this level, building serious wealth becomes almost inevitable. Your money develops momentum that is increasingly difficult to stop. You also gain something money cannot directly buy, but wealth can provide. You gain options. At this level, you are no longer trapped by your paycheck in the same way. You cannot retire yet, but you can make career moves that others cannot. You can negotiate more aggressively or join a startup with equity upside, because walking away is not financial suicide. This is the hidden power of this milestone. It is about the freedom to make decisions based on opportunity rather than desperation. But ironically, the discipline required to build this wealth becomes harder to maintain when the rewards get bigger. It is like learning to drive in a simple sedan and then being handed the keys to a high-performance sports car. The basic skills are the same, but the stakes are much higher. Many people stumble because they mistake having options for having unlimited options. They confuse being strategic with being reckless. Every dollar you lose now costs you roughly $4 in future wealth due to compound interest. A $10,000 mistake today is a $40,000 mistake 20 years from now. The secret to navigating this threshold is unlearning the need to be clever. The biggest winners are often the most boring people. They keep buying the same index funds and living in the same reasonable house. They ignore the voice in their head that says they are not maximizing their potential. They accept that slow and steady really does win the race. In terms of time, $250,000 is actually halfway to becoming a millionaire. If you are consistently investing $10,000 a year at 8%, it takes about 14 years to reach your first $250,000, but it takes roughly the same amount of time to go from that point to $1 million. The same amount of time for 3 times as much money. This is the moment compound interest starts shouting. Your money has finally built enough momentum to roll downhill without you pushing the boulder. But knowing this creates its own trap called acceleration anxiety. You think there must be something you can do to speed it up. This is backward thinking. Your job at this level is not to accelerate the process. Your job is to not screw it up. Your money has reached escape velocity. The worst thing you can do is interfere with that momentum by getting creative. As we look toward the future in 2026 and beyond, the principles of wealth remain the same despite the changing world. If you have enjoyed this deep dive into the psychology of wealth, please remember to like this video and subscribe to our channel for more financial insights. We would love to hear from you in the comments. What is your biggest challenge in staying disciplined with your investments? The difference between people who build lasting wealth and those who sabotage themselves comes down to simple rules. The $250,000 rule is about what you should not do. Stay boring and stay disciplined. Let compound interest do what it does best. The hardest part was getting here. The next hardest part is not destroying it on your way to becoming a millionaire. Thank you for watching, and we will see you in the next segment.